Yeah. If I could get everybody to take their seat, we'll get the next lecture going on. Sorry? Wow, people actually came to this one and not the judges. You know I'm not the judge, so I don't know if you guys know that.
Oh, man.
Yeah, I know. Out. So my lecture here, I want to give you a little 45-minute talk on the place and the role of finance and financial markets in a free society. And it's in the sequencing of classes, it's very apt that it comes right after Professor Herbener's talk on fractional reserve banking, because in the last lecture that you listened to, he talked about some of the problems, why we have fractional reserve banking, where it came from, but really what are the problems that it creates. And the problems, they're really not unknown. All economists understand these problems. I mean, Lucas, do you teach intro econ or intermediate macro? I mean, it's pretty standard in the textbook that you talk about the problems of fractional reserve banking, but then you kind of brush them aside and, well, that's the banking system we have and it's better than nothing, so that's kind of it. And that all said, we have this fractional reserve banking system, and for us, when you personally need financing, probably the first place you go to is mom and dad. But then after mom and dad, if you're like me, and then after your parents cut you off finally, then you go to the bank. So you want to finance your education, go to the bank, take out a loan. You want to buy a car, go get a consumer loan. You want to buy a house? Fantastic. That's what banks are there for, right? You go and borrow from the bank. And at the same time, if you have savings, if you want to make an investment, oftentimes you go to your bank to make investments. I mean, you have some savings. You're in the bank anyway, sure, I'll buy a savings product. And it's very strange because the bank is the first place we go to for most of our savings and investing decisions, our investing and lending decisions, rather. But Professor Herbener just said, well, fractional reserve banks, there's a lot of very difficult, thorny issues with them, and they don't function all that well, or as well as you'd think. So I want to give you kind of the alternative of where financing would take place and how it would take place in a free society, one without fractional reserve banks. So to just get a little bit of brief terminology out of the way, finance, if you want to give it a concise definition, it's just the study of investments. But included in investments are many subtopics that are very important, and some of them you haven't gotten to yet in the sequencing of classes. The time value of money, if you've taken an intro finance or economics class, this will oftentimes come up. Just the idea that, what's the expression, a bird in the hand is worth two in the bush? Is that how it goes? You'd prefer to have things now rather than wait into the future for them. I'm not going to get into that right now because Professor Herbener tomorrow will give a lecture devoted to time preference, interest rates, and really the time value of money. But just suffice to accept right now that we would prefer to have money now versus the same amount of money in the future. The concepts of risk and uncertainty are inherent in investment decisions because you're buying an asset today in order to get a sum of money in the future, so you don't know how much you're going to get or whether it will pay out or anything like that. Legal regimes are oftentimes important. Like, for example, who's taken an intro finance class where they talk about different investments that you can make? And oftentimes, when you get to the distinction between... Can you hear me? Joe can't hear, so he's going to stand right here for the rest of it, yeah. I can yell. Maybe I'm just talking. Okay. Oftentimes, we'll say, well, the big distinction between stocks and bonds as investment vehicles has to do with the legal regimes, that bondholders are secured creditors and they're higher in the hierarchy of who's going to get paid off if the asset goes bankrupt. Again, I'm not going to get into it, but the topic of finance includes many subsidiary topics that will come up throughout the remaining days of Mises University. And then financial markets themselves, which are much more important for this lecture, are just the place where lenders and borrowers meet together in order to strike deals that are mutually beneficial to make investments or to borrow from each other. And these lenders and borrowers, if you're a lender, it would be somebody, again, these terms haven't been introduced and they won't until tomorrow, but somebody with low time preference is somebody who's willing to not consume today but wait until the future. And somebody with high time preference is somebody who lives in the here and now, wants to spend money today and is not willing to wait until the future. And really the financial market is where these people with different preferences can meet, in the same way that the t-shirt market is where people with a high preference for t-shirts meet with stores who have a low preference for t-shirts. They get together and they strike deals. Financial markets are no different. It's just that the preferences are a little bit distinct. And the actual financial markets that we have are, the normal ones. Well, actually, the normal ones you think of are probably the capital markets, the stock and bond markets. Then you have money markets, which are like short-term lending, oftentimes through banks, actually, but that's bad. I don't want to get into that. Futures markets, a little bit more complex, or commodities markets, buying wheat, gold, whatever have you on organized exchanges. So that's just as a brief intro on the type of markets we're looking at. But really what's important is the preferences that people who are meeting in these financial markets actually have. So here's our preference ranking, basically from yesterday. Person A would most like to have a car today, and then he would like to have $10,000 in his pocket. And if not that, he'd prefer to have $10,500 next year, and all the way down. And then he'd like to talk to Joe Salerno. And I shouldn't be so hard on Joe, because I just didn't have room to extend the preference ranking down. But Dave Howden isn't even, he's like way down there. The 100th preference rank. So Joe's actually doing really well. And then person B is a little bit different, which is important. He would most prefer to have $10,500 1 year from now. And then he'd like to have $10,000 today. And then he'd like to have $9,000 today, all the way down to having a chat with David Gordon, who's also not here, so I'm not even anywhere near this high on David Gordon's preference ranking. And the important thing when you look at person A and person B is that they have reverse preferences, because right here, person A would much rather have $10,000 today than $10,500 next year, which is the exact opposite relationship to person B. And so you can imagine that there is scope for a trade to be made where person B, who has $10,000, trades it to person A, and person A trades back to person B a promise to pay back $10,500 next year. And then, of course, what's person A going to do with the $10,000 they just got? Buy the car, satisfy the most pressing want that they have. So we've got a disagreement of values, but the value that we disagree with is the value of our time or the value of the money over time for each person. And the values are completely reversed in what they want. And from these reverse valuations, we can also create the interest rate, or we can also determine the interest rate for lending and borrowing money. So person B, since they're going to lend A $10,000 today and then get back 1 year from now $10,500, that's the same thing as saying they're going to earn a $500 interest rate, and 500 on 10,000 is 5%. So they just invested in person A, some kind of an investment, let's say a loan, at 5%. And person A is in the exact opposite situation. They have to pay back that loan at 5% interest to person B. So we have a very simple scenario that defines the lending-borrowing relationship between two people, and it stems ultimately from disagreements or conflicts on the preference rank where two people have reverse preferences. Now, one of the things that I always start with in class, because for some reason there is this, I don't even know what you call it, this people are psychologically predisposed to think that lenders are good people. No, maybe that's not the case. That people who have excess money, like they have savings and they can lend it to others, they're good people, and people that are in the position where they have to borrow, they're deadbeats, or they're bad people, or there's something bad about and wrong about having to borrow money. But economics, because it's a value-free science, we don't take these positions. Like, being a debtor isn't inherently good or bad. Maybe it could have been a bad decision after the fact, but you never know that ahead of time. Being a debtor is just something that might be necessary given the person's situation. Like that person who preferred to borrow money now rather than save their money, that person's not bad, and they're not stupid or anything like that. That's just their preferences. And at the same time, lenders or savers, they're not inherently virtuous. Like, they're not great people just because they're lenders or savers, although, that's something you should strive for personally, I think. But it's not naturally virtuous. Or in the same way, another way to look at it is a lot of mainstream economists think savings are terrible because that means you're not spending money, and if you're not spending money, you're not creating income for other people. So they think that you're a miser and you're somebody that's bad, but that's not true either. It's just you have preferences for saving and borrowing, and it's neither good nor bad. It just is. So I just wanted to get that out of the way before we start. Now, Professor Herbener gave this lecture on fractional reserve banking, and I wanted to give you kind of an in-depth look of how this financial contract works, like how the lending actually works and what it means for you. And before I start, just out of curiosity, put your hand up No, wait. I should ask the question before I say that. Who thinks that they are the owner of money that's deposited in their bank, the legal owner? Put your hand up. Joe, you do? Yeah, but I'm glad you did. In fact, your bank is actually the legal owner. According to the letter of the law, your bank is the owner of money that you deposit in it, which is really strange. I mean, I'm offended by it. I don't have a better word for it. I think it's completely ridiculous. I worked hard for that money, and I entrusted it with a bank, and now they're the loaner all of a sudden. And it's very strange, but it flows naturally from this very strange legal framework that fractional reserve banks function within. So the base deposit contract, it's a bit of a hybrid. Well, it's not a bit of a hybrid, it's exactly a hybrid because it combines two fundamental financial contracts. You deposit your money in a bank, and we'll get into the details of what that means in a moment, and then your bank